Horrible looking bond auction today. Bond yields are soaring after an abysmal $44 billion 7-year bond auction, which showed some of the weakest demand that we have seen in years. So, for those that are not familiar with how a bond auction works, it's in the style of a Dutch auction. You have a starting price or a when issued, and you must go down in price, offering more and more of a discount until all of the supply you are trying to auction off gets accounted for, gets a bid. In this case, you have to offer a pretty significant discount. You have to take from the starting price or the when issued, you have to go down $40 to entice enough buyers to come buy your debt in this case. Now, remember, with a bond, as you are going down in price, what that means is the yield is going up. They are inverse to each other. So as the Treasury must offer more and more of a discount, you are getting a higher interest rate. And again, the Treasury would like to minimize the amount of interest that it sells every single bond at, because when you're talking about $44 billion, even just 1 basis point equates to pretty eye-watering sums of money for the U.S. Treasury Department. Now, again, the discount, the degree of the discount, that is referred to as a tail. The bid to cover, this is the total amount of bids divided by the total amount being auctioned off. In this case, the bid to cover would be 1.0. Anything below that, and you have a failed Treasury bond auction. Over here, of course, a higher bid to cover indicates stronger demand. And we also see the opposite of a tail, which is where the Treasury actually gets to issue at a higher price or premium to what the bond was trading at going into the auction. And again, what that means is that the Treasury gets to save a little bit of money because with a stop through, you end up issuing the bonds at a lower interest rate than it was trading at going into the auction. That was a stop through indicating strong demand. Well, we got a tail of 0.6 basis points. This is the largest tail in 13 months, or tied for the largest tail in 13 months, as we can see from this chart from Zero Hedge. Bid to cover 2.4. Now, this was significantly down from last month's auction and the lowest in 2.5 years. So if we go over here, this red line indicates the bid to cover. And again, this is total amount of bids divided by the total amount of supply, a pretty intuitive proxy for demand. We can see that the bid to cover is the lowest in 2.5 years. Now, not only that, but it actually gets worse. So if you look at who was buying the $44 billion of these 7-year notes, we can see primary dealers, these are buyers of last resort, took down 12%. Direct bidders, these are hedge funds, pension funds, family offices bidding directly for their own portfolio, took down 31%. Indirects, this is foreign demand. Those foreign buyers of U.S. debt, they took down 56%. Now, this is the lowest in 4.5 years. So here's yet another chart from Zero Hedge showing the indirect. Again, this is a way to think about, way to conceptualize foreign demand for U.S. government debt. We can see that this is the lowest going all the way back to early 2021. Really, this is a pretty poor auction. Andy Constant, pretty well experienced veteran bond trader, macro guy, gives every auction a rating. He gave this one a D minus. You don't often see him give many D's, or especially D minuses. So I hesitate to think what an F would look like if he is giving this a D minus. This is pretty bad, and again, indicating pretty weak demand from not only foreign buyers, but of course also tied for the largest tail in over a year. Bid to cover down significantly from last month and the lowest in 2.5 years. And then, of course, the foreign demand is quite weak as well. So why might this be happening? Well, if you missed the video this morning, we got GDP out. GDP came in very, very strong, 3.8% annual rate for second quarter. Now, of course, remember that the first quarter was negative. Second quarter is coming in at 3.8% real inflation adjusted growth rate, and the third quarter is running at 3.25. So the economy is doing much better than the bond market had been expecting. So these data points are surprising the bond market, which again, over the past month or so, we have seen yields falling. Well, the reason for that is, for some reason, the bond market was worried about growth. And so therefore, the bond yields came down, or the bonds got bid, and this happened across the curve. We saw a bit of a bull flattener, because remember, the bond yield is inverse to the price. So when the yield is falling, we see the actual bond itself is getting bid, as we could see there, and that is getting priced out. The data this morning, as we can see, by the way, the Fed cut interest rates here on Wednesday of last week, and bond yields have only gone up, whether it's the 30-year, the 10-year, the 2-year, the 5-year, even the 1-year has gone up since when the Fed cut. So again, the strong economic data this morning indicating, hey, bond market, you were wrong. Yields were too low. The U.S. economy is actually in a much stronger position now. This has a trickle down effect too to the short end of the yield curve. The 7-year is what's referred to as a note. It's kind of in the middle, right, between a bill, say a 3-month Treasury bill, and a 30-year government bond. It's kind of right in the middle, kind of there, right there with the 10-year. So to some degree, expectations of short-term interest rates, or the accumulation over, say, 7 years of the short-term interest rates over the next 7 years, to some degree, the Fed plays into what the appropriate yield should be. Now, again, if the yield is too low for what the economy is indicating, you are going to see very, very weak demand. Well, to add on top of that, another reason that we might have seen weak demand is if the economy is much stronger than everyone had kind of expected over the past month, right? And the growth concerns were misplaced, as this channel has been saying, then you would see not so many Fed cuts, right? Like, there had been an expectation that the Fed was not only cut 25 basis points this past week, but that they were going to cut another 2 times by the end of the year. So another 50 basis points of cuts were priced in. Well, if the economy is much stronger than had been expected, than the market had realized, the Fed doesn't need to cut nearly as much. Well, if the Fed's not cutting nearly as much, of course, short end rates are going to move higher. The bonds will be selling off. And sure enough, that is exactly what we see. So here, the 2-year yield is up significantly today, from about 3.59 to about 3.66. So about 7-8 basis points for the 2-year. The 10-year yield is up, and the 30-year yield is up ever so slightly by just about 1 basis point. Now, the higher interest rates are dragging the dollar higher, and this has been the case for the past week or week and a half. Now, of course, the S&P 500, this did not help to bring a bid into the S&P 500, and so the weakness that we have seen from the S&P 500 this morning. Now, remember, the reason that the stock market would go down was strong economic data, whether it's initial jobless claims, GDP, durable goods. All of the data points we got this morning point to a stronger economy. Now, the reason that the stock market is down is because, of course, the stock market is only going up because it is hoping and expecting and addicted to cheap, easy money. Lower cost of capital, lower interest rates. That's all that it really cares about. And so if we are going to be getting less Fed rate cuts, then again, the market had been expecting, because number one, the economic data is strong, as we could see this morning. If you missed that video, GDP, durable goods, initial jobless claims, all of them beat to the upside. Well, if the economy is stronger than expected, the Fed won't need to cut nearly as much. And so some of this rally had been pricing in, okay, the Fed is going to cut, of course, the meeting last week, but then also another 50 basis points by the end of the year. Well, if that is looking less likely, not only will you get higher interest rates across the yield curve, like we are seeing a bit of a bear flattener across the yield curve with short end rates up the most. Not only that, but you will also probably see some weakness in the S&P 500. It's very counterintuitive. Why is the stock market going down if the U.S. economy is actually doing better than expected? It's because the two things are completely divorced. They've always been somewhat divorced, but I think over the past 5 or 6 years, it's pretty obvious that they have become completely divorced from each other. And of course, there's concentration issues, there's valuation issues, there's all sorts of issues with the indices right now. But this strong data this morning, again, indicates that the Fed might not need to cut interest rates nearly as much as the market had been planning. Therefore, you see the stock market selling off. So again, D minus rating from Andy. You had a tail, the tied for the largest tail or the largest degree of discount that the Treasury had to offer. Tied for the largest tail over the past 13 months. The bid to cover down significantly from last month and the lowest in 2.5 years. 44 billion was sold. And of course, indirect bidders, again, this is foreign demand. This was the lowest going all the way back to February of 2021. Now, this is somewhat in line, by the way, with the video that we did on tick data, and that refers to cross-border capital flows and the degree to which foreigners are buying our debt. So if you have not seen that, I will link that right now, and you can go check that out, indicating relatively some similar themes there with kind of waning demand for U.S. government debt, U.S. Treasury bonds. So anyways, hopefully that was helpful, and I'll catch you in the next one.